Have you ever wondered how those massive corporate scandals, the ones that make headlines for weeks, actually get exposed? It often boils down to a few financial investigators following the money. Today, we're pulling back the curtain on the world of forensic accounting to reveal 7 key ways these financial detectives uncover corporate wrongdoing. First up, forensic data analytics. Investigators don't just look at a few spreadsheets. They use powerful software to sift through millions of transactions. They're searching for anomalies like payments made at odd hours, duplicate invoices, or transactions that don't match any known vendor. These digital breadcrumbs are often the first sign that something is seriously wrong. It's like finding a needle in a digital haystack, but for fraud. Second, the good old-fashioned document review. This isn't just about reading emails. Investigators scrutinize everything: contracts, expense reports, board meeting minutes, and internal memos. They're looking for inconsistencies, forged signatures, or altered documents. A single suspicious expense report for a business lunch that was actually a lavish vacation can unravel an entire scheme. It's detailed, painstaking work, but absolutely crucial. Third is what we call lifestyle analysis. If a mid-level manager is suddenly driving a sports car and buying a mansion on a modest salary, investigators take notice. They'll look at public records, social media, and other sources to see if an employee's lifestyle matches their known income. A sudden, unexplained jump in wealth is a massive red flag that they might be funding their new toys with company money. The fourth method is surprise audits and cash counts. Unlike a regular, scheduled audit, a surprise visit gives fraudsters no time to cover their tracks. Investigators will show up unannounced to count the cash in the vault, verify inventory, or inspect physical assets. If the numbers on the books don't match what's physically there, it's a clear indicator that funds or assets have gone missing. Fifth, we have interviews and interrogations. This is where the human element comes in. Investigators are trained to ask pointed questions and read body language. They might interview dozens of employees, from the CEO down to the mailroom clerk. Often, a nervous answer or a slip of the tongue from one person can provide the key piece of information needed to connect all the dots. Someone always knows something. The sixth technique involves analyzing shell companies and offshore accounts. Criminals love using complex corporate structures to hide money. Investigators trace funds through layers of fake companies, often registered in countries with lax financial regulations. By mapping out these complex ownership webs, they can prove that money was being laundered or siphoned off for personal gain. It's a global game of cat and mouse. Finally, the seventh method: whistleblower hotlines and tips. Believe it or not, many of the biggest scandals are broken open by a single brave employee who decides to speak up. Companies with strong ethics programs have confidential hotlines where employees can report suspicious activity without fear of retaliation. These inside tips give investigators a powerful head start and a clear direction to focus their efforts. So, from high-tech data mining to old-school interviews, these are the methods financial investigators use to hold corporations accountable and bring scandals to light. It's a complex and fascinating field that keeps our markets fair. Thanks for watching. If you found this interesting, make sure to hit that like button and subscribe for more deep dives into the world of finance. See you in the next video.